So the next session will be from Severin from 21X. He is the head of business development, and I think one of the early members of the 21X team. So he's been there right from the beginning. And for those of you who don't know 21X, I think we can say they made history last year by becoming the first regulated exchange in Europe for the DLT pilot regime. They just recently also announced their plans to expand to the US, and Severin was kind enough to prepare some learnings they've had while building 21X over the last years. So thanks a lot, Severin, in advance, and the stage is yours.
Thanks. Can you all hear me?
Yes.
All right. So yes, as mentioned, Maximilian, I'm one of the early employees. So I, like looking at the lessons learned, I also looked at some old slides. So why have we chosen to build 21X? I think it was quite obvious. We've been in the tokenization space since like 6 or 7 years for now. Like I always like to say 7 years too early. But now is the time, as we've just seen in the votings. But one of the reasons was obviously the European DLT pilot regime, which was released on May 2020 as part of the European Digital Finance Package. And we just saw that unfolding. We couldn't believe what the regulator allows to do in this new regime. And another reason is basically that we've seen what's happening in crypto by applying DLT technology for trading and settlement. So the two combinations, and this was our thesis back then, slide of 2022 from ours, is we said like this will unlock those 1,540 trillion of assets worldwide, even including non-traded assets and any type of real-world assets that will be made accessible through tokenization. And so the way we looked at this is basically, we thought like, okay, what's happening in crypto market? There are decentralized exchanges that enable peer-to-peer trading without intermediaries of crypto assets. So what's Uniswap built or other decentralized exchanges is basically trading crypto assets against stable coins atomically while building liquidity for these assets outside of a centralized system. And this idea was just amazing. If you could build something like this for securities, you would remove just quite a bunch of intermediaries in the value chain, which would make trading more efficient. It would allow for instant trading and settlement. We just talked about atomic settlement. We talked about 24/7 trading. We talked about T+2. Maximilian mentioned it, like T+2 days. On 21X, we're currently trading in T+2 seconds. And like the intermediaries in between, if to give an example, if you trade on your retail broker as a person today, you have 15 intermediaries between a buyer and a seller. And with the regulation, the European regulator, so ESMA and the European Commission just had brought out back then in 2022, it was possible to reduce the intermediaries between a buyer and a seller to just one single smart contract. So this was our plan, and we worked on that from the announcement of that new regime, and we handed in our license application in March 2023 as the first company for a combined trading and settlement system for tokenized securities, or how we called it back then on RDEX, a regulated decentralized exchange. So this was the plan. How was the execution? And on the execution side, even if we are allowed to directly onboard retail, which is also a huge innovation, we decided to go for a B2B2X model. So the way 21X is scaling today is through still through intermediaries. We're connecting to the leading brokers, the leading banks, the leading wallet infrastructure providers as intermediaries that have access to the trader itself. However, what we were very focused on from the very beginning is that we want to build an open ecosystem. We built this multi-chain, we build it self-custody enabled, and we also build it on public permissionless blockchain to be compatible with what has been done in the crypto asset ecosystem. So already today, like the process flow that we have built, it's quite more efficient. I mentioned reducing settlement times from 2 days to 2 seconds. In private assets, like you even have settlement times that are way longer. And so going ahead, what we have built is an on-chain market infrastructure for securities. This infrastructure exists out of an on-chain and off-chain part. We are a regulated financial institution, as mentioned, the first combined trading and settlement system for securities in tokenized form. So we have built off-chain what we call the identity and compliance layer. So we do regular KYC, we do whitelisting, we heard it from Thomas before. On 21X, only verified participants that have done their KYC and AML checks can participate, but they do so in using their own self-custodial wallets. And so what is on-chain in our ecosystem? So the on-chain part is the order book. We considered different design mechanisms. So in the end, we didn't opt for an automated market maker for good reasons, like slippage, impermanent loss, but also like the adoption and the institutional grade infrastructure we wanted to build. So we decided to opt for a central limit order book model, but on-chain, enabling tokenized securities, such as the Galaxy stock, for example, to be traded against stablecoin on the blockchain with just a simple whitelisted wallet. And so an example trade on 21X, and this is up and running live, both primary and secondary market on our infrastructure. An example trade is as follows. You use your stablecoin as a buyer. You place a buy order while a seller places a sell order with their tokenized Galaxy stocks, to stay with the example. And when the prices match in the order book, the smart contract within one single blockchain transaction exchanges both the asset and the cash side of the transaction. And this enables us and everybody working with us to have a way more efficient trading and to cut out the central securities depository, to cut out the CSD out of the equation, and to be able to use still their self-custodial wallets. So we're the only exchange and central securities depository where actually no deposit happens. So the custodians in our system are the banks, the crypto exchanges, the brokers, the treasurers connecting their wallet to our system. So this is what we've built. But what have we learned out of this journey? I mean, we've been the first ones to go this route, and we also got the approval from the highest regulators in Europe. And we learned quite a lot of things along the story, along the journey. So one thing I mentioned is we opted for a B2B2X model. Another thing I mentioned, we went for a central limit order book. So as the automated market maker would have no need for market makers, as we know it from crypto, a central limit order book still depends on market makers. So looking at those different client segments, one example of a challenge we had is finding market makers that are able to both interact with financial securities and also with wallet technology. So the adoption curve in the beginning was quite hard. In the meanwhile, we're live with the first market maker and have a good pipeline of market makers being onboarded with the upcoming assets. And also, like we have issuers who take that role by themselves. But that's something that we in the beginning underestimated, that like we're still trading securities here. So you need to be licensed to act as a market maker on tokenized securities. Another learning we had is that even if all banks and financial institutions are working quite a lot in the space, they have huge change costs. So we started to do POCs with the banks, such as the one with Deca Bank or ABN AMRO announced recently, where they use their wallet infrastructure to trade on our order books. But the adoption curve from financial institutions is slower than from the Web3 perspective. So the way we've structured our go-to-market is by looking into money market funds, where we have a lot of high-quality issuers, and looking into the treasury use case with Web3 foundations, with Web3 service providers, with custodians, and also wallet infrastructure providers that enable on-chain treasury management for their customers. So in the end, what we enabled and what we've been licensed to do so is, and as the only exchange in the world, is smart contract-based trading for tokenized securities. We enable direct connection of a treasurer to an exchange. We enable settlement through stablecoins, so you don't need to settle through your SWIFT system and your traditional rails. We enable peer-to-peer trading, and all of this is self-custody enabled, while 21X can simultaneously act as the on-chain TA, so the transfer. Okay, so basically, we also enable, last point on this slide, on-chain registry for tokenized securities. So in our role as a settlement system, we can also be the transfer agent or the registrar of a natively tokenized asset. And this we have been permitted by ESMA, supervised by BaFin in Germany. And to the question we had before, we're also working with central bank digital currencies as part of the ECB trials. Wrapping it up. So we figured out that our early customers are rather the Web3 investors and the treasuries of those companies. We figured that crypto exchanges and crypto brokers are way faster than the banks. So because they have wallets already and stablecoins in those wallets. And we also are working with the leading wallet infrastructure providers to enable native swaps out of their wallets and for their customers. And last but not least, I mean, we're still institutional grade. We're working with all the banks, but we just see that the adoption curve in TradFi is slower than it is coming from Web3. What's coming up next? I mean, Maximilian, you told it before, you mentioned it in the beginning. We kicked off this infrastructure in Europe. So we received our DLT TSS license. We launched on Polygon. We went live with our partners, Apex Group and SBI Digital Markets for tokenized money market fund strategies. We went live with the secondary market, implemented Oracle price feeds, and what's coming up next now is scaling into other markets, especially as a next step in the US market, where we're in active conversations with the SEC and the crypto task force to get or to use the blueprint we've built in Europe and bring that to the US market. In the meanwhile, we're also ready with our multi-chain setup. We launch on our second chain, Stellar, this year, having lined up further chains for early January. And we also will enable 24/7 trading and 24/7 operations, therefore, for the broker setup, which will be ready beginning of next year. So stay tuned to everything that comes, and happy to answer any questions.
Thank you so much, Severin. And there are some questions already. and one of these addresses a point you have been talking about already, with the go-to-market strategies. So maybe we interpret this question more on a forward-looking basis. What do you think now that you've had like your first experiences and learnings when it comes to who to address with your products in order to grow adoption quicker? What do you think will be more difficult for you guys to grow assets listed, like the supply side of the marketplace, or do you think it will be harder to attract the demand side?
That's a good question. It's always the chicken and the egg, right? So I don't think that there will be like a shortage on tokenized assets anymore. So we've seen what BlackRock and Franklin are doing. But on the money market side, we see tokenized ETFs as another trading product, which is currently being pursued by most asset managers. And so we see the same thing happening with tokenized stocks. It began with tokenized tracker certificates, so no real native stocks, but available in large sizes and available through wallet infrastructure, fulfilling a very necessary need. So the asset side won't be an issue. On the distribution side, there's huge demand from everybody working in Web3 to invest in their stablecoins. So we're working with treasurers, we're working with DeFi pools, lending operators, staking operators. All of those earn money in either crypto or stablecoin, and their treasurers want to have a diversified strategy. So the treasury use case is one that's picking up early on. The collateral use case is the second one we see unfolding. So we already see some DeFi pools doing looping strategies on their private credit funds. I think it's interesting to watch what's happening on the collateral side in Web3. But the point when all of this will really scale is when the large crypto exchanges and the brokers are connected to 21x, and to have real multilateral trading of those securities, meaning we have real liquidity in the space. So it's an orchestrated launch. We start with Web3 companies and treasurers while we're preparing for the brokers and the banks. You're on mute, Maximilian.
Yeah, rookie mistake. Thank you very much. The last question is more technical, and it concerns what type of wallet or account and architecture are you supporting? Do you use like externally owned accounts, or what do you use on this front? And I think there was also another question in the chat regarding the ERC standards that you're using at 21x.
Okay, so we always designed our market infrastructure as an open market infrastructure. So any type of wallet should be usable with our system. It needs to be a whitelisted wallet by a verified customer. So we launched our market infrastructure on Polygon POS. So it needs to be an ERC20 compatible Polygon wallet with Polygon stablecoins on it at launch. But we're expanding to Stellar, Solana, ETH, and other chains, and the respective wallets and token standards will depend on the chains that the trading is happening on for the specific assets. So short answer, we're supporting all standards as soon as they are fulfilling our minimum requirements. On Polygon, it's ERC20 compatibility. We also support ERC3643 as an example. So that's the EVM token standards. And on the wallets, it can be any wallet infrastructure. It's a bring your own wallet, self-custodial wallet setup. So a lot of the banks are using Fireblocks or Ripple custody solutions on the institutional side, and others on the treasury management side rather use providers such as Safe, DFNS, or others.